The logic behind the market beta factor. Clearly, the premiums from market beta have been consistent and pervasive. The factor has been affordable since first conceived. But can we explain the factor's performance logically? Several explanations exist for the large size of the equity premium. The first risk-based explanation for the market beta premium is that a correlation exists between the risk of owning securities and the macroeconomic risks. During an economic downturn, investors commonly suffer loss of job or business income, as well as losses from a crashing or bearish market. Financial distress may force them to sell their stocks when the prices are lowest. A second explanation pertains to high net worth individuals owning a large percentage of equities. They have attained a level of wealth where their desire to gain more income has waned. They do not need to take a risk unless the risk premium is sky high. Another logical explanation relates to how people invest in securities at different stages of their lives. Young investors are more interested in equities because of the higher premium and because they have a long future ahead of them, for which they want to save and own. However, they typically have lower incomes and higher borrowing constraints, so their overall share in the equities market remains limited. Older individuals, on the other hand, are less inclined to take risk and are typically withdrawing from the equities market. Consequently, middle-aged consumers saving for their retirement and their children's college education own the major share of the market. It is also a known fact that stocks are much more volatile than the one-month US Treasury bills, which are almost riskless. Additionally, the risks of owning stocks correlate highly with the economic cycle. For example, the Great Depression was the worst period for the US. Equity markets fell 43.5% in 1931. From the financial year 1929 through 1932, the equity market lost over 83% of its value. The return from the one-month US Treasury bills was plus 6% during the same period. The above discussion proves market beta meets all the criteria that make it worthy of consideration for inclusion in a strategy. How much you allocate to this factor, however, depends on how much risk you can afford and how much risk you are already exposed to in your portfolio. Successful investors also consider the correlation between their existing assets and the new assets they plan to purchase. Just like a master chef who not only considers the individual ingredients in a recipe, but also how those ingredients combine to create the right balance of flavors. Never look at the risk of an investment in isolation, but in terms of its incremental effect on your complete portfolio.